Asian markets are mixed following Wall Street's tech slump as gold reaches yet another record high on the back of economic fears. Germany shifts course with a $550 billion boost for defense and infrastructure, reshaping its economy and global role. Meanwhile, EU trade plunges just as Trump's tariffs take effect, setting the stage for escalating tensions. Hello, I'm Taiba Aydin with the latest business and finance news here on TRT World. Asian stocks were subdued on Wednesday following a tech sell-off on Wall Street. Mainland China's CSI 300 was flat, while Hong Kong's Hang Seng index edged down around 0.15%. Japanese markets were in focus for investors as the Bank of Japan held interest rates steady at 0.5%, in line with expectations, as the central bank weighed the potential impact of US President Donald Trump's tariffs. The benchmark Nikkei 225 was up marginally, while the broader Topix index increased around 0.6%. Meanwhile, gold prices continued to climb to new highs, hitting a record of more than $3,044 an ounce as economic worries and a shifting geopolitical landscape kept risk appetite in check. For more on this, we're joined by Josh Mahoney in London, Chief Analyst at Scope Markets. Hi Josh, now tech stocks made some significant gains earlier in the week in Asia. What's behind the retreat today?
Well, look, with every move higher, you're expecting to see a pullback or at least a pause at some point. And certainly Chinese stocks in particular have done incredibly well in the absence of those gains in the US. Certainly with the fact that we saw that the US markets had rolled over, it was time to pause. That doesn't necessarily mean that the theme of capital flows out of the US and towards areas like China, areas like Europe is over, because certainly from a price to earnings ratio, US markets remain very expensive. The S&P 500 price to earnings ratio roughly around 25, with the Hang Seng around the 15 mark. And so there's still plenty of fuel in the tank in my mind. But it also comes down to the fact that people need to, at some point, be able to see that there's a breather, because markets can't just continuously push higher, especially given the question marks that are in play around global trade at the moment.
Right, and in the meantime, gold prices have been hitting new highs every day. How long do you expect the upward trend to continue?
Well, it wasn't that long ago that we were talking about, are we going to reach 3,000? And I said, I believe we will, and I think we'll push well beyond that. I still believe that. I think that there is the basis for gold to outperform for some time yet. When we see interest rate cuts, generally that instigates a bull market, or it's in the middle of a bull market. It's not necessarily something we see at the end. And therefore, I think there's a good chance that we still have years of this, especially given the framework of significant concerns around the sort of fiscal positions of many of the biggest countries in the world.
And we also have the US Fed decision later in the day. What are markets pricing in?
Well, they're not pricing much by way of movement in the Fed funds rate, but it's still an important meeting. And that's because we need to know exactly what the Federal Reserve are willing to do if Donald Trump essentially drives the US economy over a cliff. Will they cut rates? Would they enact QE? In all likeliness, we probably won't hear about either, because they're likely to say we're data dependent. And that means that Donald Trump has a job of keeping inflation down. And that's key to being able to unlock the power of the Fed.
Right, Josh Mahoney, Chief Market Analyst at Scope Markets. Thank you very much for being with us. German lawmakers have approved a massive increase in defense and infrastructure spending. The reform allows military and intelligence funding to bypass strict constitutional debt limits, which are set in Germany's constitution. It will also allocate over $550 billion for modernization of hospitals, schools, roads and energy networks over 12 years, signaling a shift from decades of fiscal conservatism to proactive investment. The approval is a majority win for Conservative leader Friedrich Merz, handing the incoming Chancellor a financial windfall to accelerate investment after 2 years of economic contraction. Merz insists the boost is vital as the EU's security situation changes.
This decision that we are taking today on defence readiness, in a comprehensive sense for our country, can therefore be nothing less than the first major step towards a new European defence community. A defence community that also includes countries that are not members of the European Union, but which are very much interested in building this common European defence together with us, such as countries like Great Britain and Norway.
For more on this, let's bring in Klaus Jürgens. He's a European Affairs Analyst in Innsbruck, Austria. Good to have you with us, Klaus. Now, given Germany's history of fiscal conservatism, could this decision mark a long-term shift in its approach to debt and public spending?
Very good morning to you. Thanks for having me. Well, indeed, it is a long-term shift. You just mentioned that what was voted upon in the German Bundestag yesterday actually has a lifespan initially of 12 years. So this is nothing which is over in the next couple of months or 1 or 2 years. And fiscal conservatism was basically the hallmark of German economic policy, which eventually became the economic engine of Europe. Now, many things have changed, and the last 2 years in particular were rather disappointing. Now, what actually is at stake, however, is much more than 500 billion for infrastructure investment, economic stimulation, including climate change, what have you. What is really a dramatic change in Germany's policy-making outlook is that from now on, the actual cap with regards to defense and military spending no longer exists. It means the government can actually invest by borrowing into the defense and security sector with unforeseen amounts of money. And actually what was discussed yesterday, another 500 billion perhaps, you can actually say it might be much more. No one knows what will happen in the world in the next 1 or 2 years or 4 to 5 years. The 1% cap from GDP is actually no longer there as it used to be there, which was basically 43.5 billion euros. This is a real change in the policy-making setup of modern Germany. So we must analyze both at the same time, the defense package and at the same time the infrastructure package. And don't forget, Friedrich Merz had to convince the Green Party to accept this change in the military spending cap. And he managed it very cleverly. Initially, the Greens were not convinced. And then including 50 billion for potentially tackling climate change, I think that made the trick and the deal possible.
Right, and how could the surge in spending impact Germany's economy, especially after 2 consecutive years of contraction?
Well, here we are. Some analysts would say increased government spending is the right thing to do when the economy is down. You know, we have this basketball scenario in economics. You know, if you want to get the ball going again, you can't just let it lie flat on the ground. You have to try to get it up by pushing, and eventually it is high up again, and then you can score a point. It's exactly the same with the economy. Some people say you have to invest when something is not going right. The problem is, if you do invest via the government and the money is not there, the money has to be borrowed. And the interesting thing is, once the government is borrowing money at some stage, it should be repaid, and no one really knows how Germany will manage to do this. This is the first observation. The second, if Germany's economy will be better up and running one more time, and eventually the output potential will reach its maximum, it will lead to an increase in prices. It will lead to inflation. Government spending alone is no cure for all. So the economic minister really must make sure that what is invested into defense and or infrastructure or what have you stimulates the economy, but not to a level which is no longer sustainable, which would lead to higher inflation, and then the whole thing would explode.
And how might this decision influence other EU nations who are struggling with budget constraints, like France, for example?
Well, this is a very, very good point, if I may say so. Now, if it works well, France and other countries in Europe might actually say, well, the Germans know how to run an economy. There were problems in the last 24 months, but let's assume they managed to get over it. Then why don't we follow the German example and reconsider our own spending limitations as well, and perhaps try to stimulate the economy? France is a very good example, but let me only, I know we don't have that much time, but think about Spain. Spanish economy in the European Union. For many decades, Spain had the highest youth unemployment all across Europe. Now, in order to stimulate the economy, one way is to create jobs. Now, perhaps other governments might say we need to stimulate the economy so that we can have better rates of employment. Better rates of employment mean more goods and services are in demand. Hence, the economy is functioning better. It sounds so easy. I know there is no cure for all, but I would not be surprised if, in particular, the Council in Brussels might say, look, what are the Germans up to this time? Will it work? Can it work? And what is actually our own situation back in Paris, back in Madrid, back in Lisbon, back in Rome? Yes, true. It might have a spillover effect indeed.
All right, and we will have to leave it there. Klaus Jürgens, European Affairs Analyst, thank you very much for joining us.
Pleasure, thank you.
Now a quick look at some of the other top business stories from around the world. Google parent Alphabet is buying cloud security startup Wiz for $32 billion in its biggest deal ever. The deal will make Wiz part of Google's cloud unit and strengthen the company's cybersecurity solutions. To secure the deal, Alphabet had to agree to a higher price to last year's $23 billion bid. Wiz earns over $500 million annually and serves clients like Morgan Stanley and BMW. Japan's exports rose 11.4% year-on-year in February, marking a fifth straight month of growth. Though rising, the figure still fell short of expectations. Analysts say the increase was driven by stockpiling due to concerns over US President Trump's tariffs. Exports to the US and China grew while imports dipped 0.7%, yielding a $3.9 billion trade surplus. The Recording Industry Association of America reported that the US music industry surpassed 100 million paid streaming subscriptions last year. Total revenue rose 3% to nearly $18 billion, but streaming growth has slowed. Music companies are now exploring new revenue sources. And Morgan Stanley plans to lay off about 2,000 employees this month to improve efficiency. The cuts affect up to 3% of its workforce, excluding financial advisors. Wall Street firms, including Goldman Sachs and Bank of America, have also announced job cuts. Economists say uncertainty and shifting trade policies have slowed deal-making activity. Well, that's all your business news for now. Thanks for watching.